housing market crash in 2025? Or more specifically, will Seattle's housing market really take a nosedive? Hi everyone, I'm Maggie, and as we near the end of the year, let's dive into a question that's on everybody's mind. What's going to happen to home prices in 2025? Some people are convinced that the market is heading for a crash, while others think prices will hold steady. So today I'll break it down for you with the recent data, expert predictions, and my own real estate experience. So before we talk about whether the market might crash, let's first figure out what a crash even means. A housing crash usually happens when prices drop really fast, like 20 to 30% or more in just a year or two. At the same time, there are way more homes for sale, but very few buyers. Homes just sit on the market and sellers can't find anyone to buy them. Another big problem during a crash is foreclosures. When people can't afford their mortgages, they default on their loans, and the banks take back the houses. Those foreclosed homes flood the market, pushing prices down even more. It becomes a vicious cycle. The 2008 financial crisis is a perfect example. Home prices across the US fell an average of 33% between 2006 and 2011. Some places like Las Vegas and Miami saw prices drop by over 50%. Tons of foreclosed homes hit the market, supply far outweighed demand, and prices just kept falling. Now, let's look at the risks people are talking about today and whether they could actually cause a crash in 2025. The first argument we often hear is home prices are just way too high. No one can afford these prices, so the bubble has to burst. Well, it's true that prices are at record highs. According to the National Association of Realtors, the median home prices in the US was around $400,000 in September 2024. And that is the 15th month in a row that prices have gone up compared to the year before. Affordability is also a big issue. The Housing Affordability Index is now at 71, which means the average household is really struggling to buy a home. And this is the lowest affordability level we've seen since 2008. So yes, the market feels like it's in a bubble. But just because prices are high doesn't mean they'll crash. Real estate is different from other investments. It's not just about the price, it's also about stability. Homes provide rental income and long-term value, so people don't sell them as quickly as they might sell stocks. This keeps the market more stable. Plus, the economy right now is doing okay. Goldman Sachs expects the US economy to grow by 2.5% in 2025, and the unemployment rate is still at a low 4.2%. With the economy holding steady, the bubble we are seeing today is more likely to soften gradually rather than burst. The second risk people bring up is rising mortgage rates. In 2024, the average 30-year fixed mortgage rate climbed to 6.78%, up from 3 to 4% during the pandemic. While rates might drop slightly to 6.5% in 2025, they're still much higher than we've gotten used to. Higher rates means higher monthly payments, which makes it harder for buyers to afford homes. Some worry this will lead to defaults and foreclosures. But here's the good news. According to CoreLogic, in September 2024, only 0.9% of mortgages were seriously delinquent, and foreclosures were at just 0.3%, the lowest level since 1999. This shows that even though times are tougher, most homeowners are managing to stay on top of their payments. So, what about Seattle? Some say the city's housing market is tied too closely to tech companies. If the economy slows or if tech layoffs increase, home prices tank. It's true that Seattle's east side, including Bellevue, Redmond, and Kirkland, is heavily influenced by the tech industry. But even during tough times, there's still very limited inventory. For example, most east side cities only have a few hundred homes for sale at the same time. Even if demand drops a little, such low inventory will help stabilize the prices. On top of that, many tech workers earn high and stable incomes. Even after layoffs, most of them quickly find new jobs. And east side neighborhoods have things like great schools, safety, and job opportunities, which keeps demand strong over the long term. So even if tech layoffs or economic slowdown happen, Seattle is much more likely to see small price adjustments rather than a crash. I get it. A lot of people are hoping for a crash, including my husband. It's tempting to think, if prices drop, I'll finally be able to buy my dream home. But the reality is, prices usually go up in the long run. Take the 2008 crisis, for example. Back then, people waited for price to drop further. But within a few years, the market recovered and prices are now, 50% higher than before the crash. As the saying goes, the best time to buy a home was 10 years ago. The second best time is now. Instead of waiting for a crash, focus on finding a home that fits your needs and budget. Real estate is a long-term investment, and time is your best friend. So, what's your take on the 2012 housing market? Do you think there are other risks or trends we want to watch? Drop your thoughts in the comments, and as always, I'll be there to bring you the latest market updates and insights. See you next time.